TheoTrade, this is Don Kaufman. It's July 12th, 2019, and you are watching the TheoTrade Weekend Update. All right, so this weekend I've prepared some fairly detailed notes that we're going to spend quite a bit of time going through some data, a couple of trade ideas. Yeah, we'll even look at bonds for a couple of moments. With that, let's get right down to it. So over here in our little scratch pad on Thinkorswim, I've created a couple of fairly cryptic notes. This is kind of what I call a market of bond shocks and gamma squeezes. So with that, let's get to a couple of the notes and write down, as I said, to it. So the first note over here says buying, well, produces more buying, aka it's a negative gamma push is on. And I'm going to explain precisely what that is, because we've got a market where effectively we're trading at an all-time high. And you look at this as a trader, and I'm just going to close up this entire left side bar for just a second. You look at this as a trader and you're like, if you're short, and I'm actually carrying some short delta, but if you're looking at this as a trader, you're like, it's not going to stop. It's not going to stop. One of the first things that you have to realize, okay, when I say like a negative gamma push happens to be on, all right, and it's a market, of this gamma kind of squeezing situation. Allow me to explain this in some context. Let's make it, definitive so that everybody kind of gets a feel for what this kind of gamma is, all right, and what negative gamma can do to you as a trader, what can force you into. First and foremost, one of the great ways to assess, okay, like gamma risk and gamma squeeze is to use the SPX, because the SPX is where, okay, this kind of gamma and negative gamma risk originates. So what you're looking at, all right, is this past week of trade. This is the expected move. Now, obviously, this is Monday, Tuesday, Wednesday, Thursday, Friday, right? Just the individual days are laid out. And as the week actually kind of progressed, we actually got caught up in a big, people call this like a short squeeze or so forth, but it has less to do with that and much more to do with gamma. And again, the great way to explain this, all right, is that you, in a week-to-week basis, have premium buyers and premium sellers. Now, lots of big professional trading firms, okay, they go out, okay, regardless of like implied volatility, regardless really of what options are kind of trading for. And again, the nice easy way to say this is they pretty much blindly sell option premium. Okay, now the option premium that they sell is typically right around the expected move. So imagine that the option premium they sold, okay, this expected move, what was it? Well, let's take a quick trip down memory lane and go back over to the Analyze tab. On the Analyze tab, go to Think Back. Think Back, okay? Just drop back a week. Now, I know this stuff, gets a little bit confusing. Just drop back a week. Drop back to July 6th. Open up, okay? And you'll see there's about a $34 expected move. So the assumption, okay, is that this little opportunistic window effectively means that some trading firm went out there and they sold options and collected, let's say, right around 34 bucks. Right? That's like selling the at-the-money straddle. It's a great way to think about it. When you sell the at-the-money straddle, when you're right here, your delta, which is your directional risk, is zero. But what actually occurs is if the market starts to go up, okay, your delta is no longer going to be effectively zero. The more we go up, okay, the more that your options delta is going to become negative. All of a sudden, your delta, okay, becomes negative, for example, 1,000. How do you offset it? Okay, well, you have to turn around and you have to buy. In this case, there is no SPX, meaning that there is no SPX stock. So what do? They buy ES, okay? They buy ES futures. They buy the S&P futures. If you buy S&P futures, okay, what's it going to do? It's going to offset your 1,000 deltas of risk. How many futures do you have to buy? Well, an ES future is approximately, okay, 50 deltas against the SPX. So how many are you going to have to buy? And you're like, boop, 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 boop. Well, it could be a lot depending upon how fast the market moves. So why do we actually, if this is about delta, why do we call it negative gamma risk? Because the gamma is effectively telling you what your delta is about to be, right? So if you're pretty quick with the math, you actually can look and say like, oh, in just a few seconds, if this market keeps going up, my delta is going to be, for instance, negative 10,000. I'm going to have to turn around and buy a lot of futures. You know what the irony of this entire situation is, okay? If you're down here and the market starts to go up, as a trader, to defend this short straddle or strangle, you have to turn around, okay, and you have to buy. What do you have to buy? Again, you got to buy ES futures. And the more you buy ES futures, the more you have to turn around and buy ES futures. But so long as we stay inside the happy place, which is this box, you're going to make money. Why? Because if you sold it for $34 and we close inside the $34 range, you're gold, Jerry, gold. And that's how a lot of trading firms function. Only problem is, okay, what happens when we cross outside of this expected move, right? Then things get a little bit nutty. But these trading firms use what they term like auto-hedging devices as algorithms that automatically hedge it. So maybe this now makes more sense to you, okay? Buying, well, produces more buying. That's what it is. You buy and then you have to buy and you have to buy more. It's hedging activity. It's, you know, the thing that a lot of people don't get is you're looking at like, you know, like, oh my gosh, you know, the market is flying higher. Yeah, you know what? The SPX was being driven higher. Why is the SPX being driven higher? Because firms go out and they sell, okay? If you take a look, like today's a really kind of mellow, chill day. Yeah, well, they did 1.2 million contracts in the SPX. You realize the entire market is only going to trade 16 or 17 million option contracts today. This is actually, it's a mellow day. It's a light day. Look, it's actually trading about 66% versus the previous 5 days. 1.2 million contracts. It's huge because this product is 3,000. You can't compare that to Apple options, right? Apple options are what? It's a $230 stock. So think about how much value is moving through the S&Ps. People always go like, who's buying the market at the all-time high? Every trading firm is buying the market at the all-time high because they have to buy the market because they buy S&Ps. And then when you buy S&Ps, it drives all the other stocks up. Okay. That is actually where we get to what's termed statistical arbitrage. Okay. So all of this relates to professional trading firms. Anyway, what you got right now? Buying produces more buying. The negative gamma push is on right now. When does it end? Well, when it does end, things get kind of wicked, but you kind of get a little bit of a reset. The next week, we get a little bit of a reset. The week after that, it's a little bit of a reset. So it doesn't necessarily pertain that the negative gamma push is going to roll over to the next week. All right, enough. We must move on. Okay, took a lot of time on that one. Now, let's get to some bond talk. Well, let's actually drop into the bonds to begin with. And here's where I say bonds, well, they better calm down or else, okay? Or else what? Or else things are just going to get totally and completely nuts over here. So that actually leads me to my next thought. Listen, the bond trade, okay? That on equivocation. This is like the most crowded trade ever. Listen, everybody right now, everybody, okay, knows that interest rates are going to go lower. So when interest rates are going to go lower, they get ahead of that curve, right? They get ahead of the curve and they buy up the rates. But the problem that you have right now, okay, is the marketplace. Like everyone is on the bid, meaning that they've all gone out there and they're buying. The entire trading arena, if you will, has bought bonds, okay? Bonds, that is one full monkey. What happens if first person starts to sell? What happens if everyone starts to head for the door? Okay. You know what? You think about this as like a crowded bar or something, and all of a sudden somebody screams fire and everybody runs for the door at the exact same time. And unfortunately, it's that wild. And this is where people will get absolutely trampled and crushed. Okay. Expect bond shocks to hit. Now, we've actually discussed a couple of really detailed trades specifically for bond shocks here at TheoTrade, specifically different types of ratio back spreads. We had a bearish trade on the bond. We actually took off a bearish trade on the bonds, specifically in the TLT, but I still have the ratio back spread all the way stretched out to October because expect more bond shocks to hit. See, right now, you got to recognize that, listen, the Fed, okay, it is what it is. Leave it alone, okay? But the long end, well, demand might suck right now, right? Or does demand suck? Well, I want you to think about something for just a moment, because that's kind of a bold statement, but take a look right now. Take a look at interest rates. So this is just a few days ago. So if you're looking right now, by the way, this is the treasury.gov site, and obviously here's today's date, but this is just a few days ago. And when I say the long end of the curve is out here. Listen, a 30-year. If you go out there and you buy a 30-year bond, you know, just a few days ago, you're going to yield like 2.5%, like 2.5% is the interest rate. Why would you go out and really want that? Why would you want to collect? Oh, I want to really collect. I really want to collect 2.5% and tie my money up for 30 years. It's what I've always wanted to do. Nobody's thinking that. No one is thinking that they want to collect 2.5%. So what's the reasoning for buying a bond out there? I'm going to tell you exactly the reason for buying a bond, because there's upward momentum in the bonds until, of course, the bonds start to turn down, in which case everybody says, hey, long end demand, it sucks. Why does it suck? Well, who wants bonds? Okay, when they're what? When they're trading, there you go, 2.5%. So what do you have to do? You got to juice up those bonds. Take a look at the bonds. It's happening right now. If you don't believe it, just look right on the screen. It jumped up 2.64. Why? Because the long end of the curve, it's yucky at this point in time. So you could actually see some steepening of the yield curve in the very near term. And that's predicated on the idea nobody wants to buy bonds, okay, for the fact that they're paying 2.5%. People want to buy bonds because they're looking for the appreciation to the upside, which for right now might be over. Now, let's get to the next point in the bond talk. Fed, well, it's priced in. The Fed's priced in. And coming into this now, and I think that this is the only way to really describe this, okay, is that their short-term collective pants are down right now, okay? The Fed has been priced in. You're like, what do you mean the Fed has been priced in? Okay? Well, take a look once again at this. When I say the Fed's priced in, they've already taken the 1 month, the 2 month, okay, and the 3 month. The marketplace has already adjusted this interest rate down. So right now the interest rate is sitting, okay, 225, 250. It's 225, 250. Well, yeah, but these are already trading like closer to like 2%. Why? Because they're already adjusted it down by 25 basis points. They've already adjusted, okay, the interest rate. So right now, when you start looking at the marketplace, okay, forget about the ZB for just a second. When you start looking at the entire marketplace, the S&Ps, everything, you have to realize, okay, the effects of a 25 basis point cut are already, okay, done for. That's already priced into the marketplace. So the Fed right now and for the foreseeable future, their pants are down. So what are they going to do? They're going to try to use a little bit of rhetoric and so forth, and they might do a little cut here and a little cut there. Don't forget this. 25 basis point cut is already priced in. There's a 100% chance of it. If there's a 100% chance of it, not only is it going to happen, but the marketplace, okay, the marketplace is not, shall I say, stupid. The marketplace sees that. And that's why interest rates right now are actually going up. Why? Because they've already priced them going down. Okay. Next, all right, closing bonds, okay, open ratio bonds. Now, this is just a couple of trades I was talking about a moment ago. We closed some profitable bearish bond positions because we've been looking for these, what we term bond shocks, all right, and we're getting just that. So we closed that and opened up a couple of ratio positions in the bonds. Now, to continue onward and upward, a little bit more generalized market discussion over here, okay, we have the SPX EM. So moving forward, one of the things we want to think about, like next week, they crushed down the volatility even more. The expected move in the coming week of trade is about $33. And if you're curious as to where we find that, look, well, at the SPX. Look at the option chain. Okay, it's $32, $33. It's tight. Okay, because remember, the previous week we had close to a $34 expected move. Again, this week, we're $32 and change. Okay, so they've actually crushed the volatility down even more. Now, I'm very, very cautious right now because we touched the expected move. We got, you know, the market, it didn't do a tremendous amount this week. I mean, what did you start at? Okay, let's not get crazy here. The market closed up a negligible amount. It's less, again, we had less than this 30-point move on the entire week to the upside. This next week, again, prices a $32 move. But with everything that's going on, I'm going to show you that here momentarily, I'm still not going to be a premium seller. Just like I told you a moment ago, these big trading firms, they're selling premium, okay? That's because they're using auto-hedging devices to mitigate risk. You and I, if we trade outside the expected move, we get hammered with that. So the expected move is tight, continue to buy options. Now, cruising down to the bottom of the screen over here, the VVIX, that's the volatility of the volatility index. The VVIX has actually picked up a little bit, okay? It's picked up a little bit. But the cool thing is, because the volatility of the volatility index picked up a little bit, it's actually made it very, very advantageous at this point to look for what's called a VVS spread. That's what we term a VIX Volatility Spread. What is a VIX Volatility Spread? Well, for the most part, we go into the VIX product, okay? We're gonna load up the VIX, and we're going to use the VIX. And by the way, everybody look at the chart of the VIX. So it's all the way down to 12. It doesn't mean that much though anymore. But if you can see, I'm 67 days out. What I've done is I've actually sold a put spread to finance the cost of a call spread. So I've sold a $3 wide put spread to buy a $5 wide call spread. Now, if you know anything about the VIX, okay, the VIX options, these VIX options that are 67 days out are not priced off of this VIX, okay? These VIX options that are 67 days out are actually priced off the September volatility futures. The September volatility futures are already trading roughly at 16. So effectively what I've done, okay, is I've actually wrapped two spreads, a spread I sold and a spread I bought right around. Here are the at-the-money options. The at-the-money options are right here at the 16 level. So that's a VIX volatility spread. And basically, the trade just says, hey, listen, anytime in the next 67 days, if volatility spikes, I want to be part of it. And that's it. That's what the trade is, right? So over and done with. I like it. I got me a VIX volatility spread, and I was afforded the ability to do that, okay? Not just because the VIX is low. Forget about the VIX being low. It's because the VIX was low, and the volatility of the VIX actually picked up just a bit in the last couple of days. That actually, punched up vol a little bit in the VIX. Let me get the trade on. Next, Amazon. Let's get to Amazon. It's kind of fun with the notes over here. I like it. Amazon on all-time highs. Well, what does that mean? What do you think it means? Okay, it means Amazon. Get ready. We're going all-time highs. Like what? Oh, come on, Prime Day. I think Prime Day is next week. You got to get yourself that 70-inch television delivered to your front door, or should I say, dumped on the front door by UPS. Anybody that's ever got anything delivered by Amazon from UPS at some point has had that thing just chucked out of the truck while the truck is still moving. Anyway, here's your Amazon Prime trade of the day, and that happens to be, take a look at that's the all-time high. Stick a fork in it. It's really, really close to the all-time high. And inside of Amazon, it's been a breakaway to the upside. Okay, for those of you looking for, a little bit of fuel to the upside, I think you could probably get away with a very short duration spread. Okay, listen, the earnings are coming on July 25th. I think you could probably get away with a really, really short duration spread. It couldn't be more than about 7 days out. Okay, really short duration spread, just looking for a pop to the upside. Okay, just in the next 7 days. So you're coming into earnings at or near the all-time high. Ooh, it's going to be exciting there. But Amazon, the reason I mention Amazon is because it's driving a lot of the NASDAQ right now. If you start looking at stuff like Google and you're like, well, what's Mr. Google doing? Here's Google over the last 3 years. That's still way off the all-time high. Microsoft is trading at an all-time high right now. Okay. Oh, yeah. Oh, that Zune is really doing it for me. If you have no idea what that is, don't worry about it. Again, earnings coming the 18th of July. But moving onward and upward from Amazon at all-time high, Netflix earnings. Okay, so one of the last thoughts I want to give you here is earnings season's coming. Okay, it's earnings season. Now, earnings predominantly kicks off with the banks. You get the JP Morgans, and I'll scroll down a little bit to some of the banks. You get Citi, okay? Citi, it's right around the corner. Ooh, but it's before the market. You can't even trade it because it's going to be out before you even know it. But then you look at like JP Morgan. Ooh, JP Morgan is coming. It's the 16th before market. Listen, okay, with the banks, and I'll use JP Morgan in this example, there's not a tremendous amount okay, of implied volatility around like bank earnings. Let me just show you right there versus right there. Now, the 7-day options versus the 14-day options, 7 days, come on, they're like, it's a mild differential, meaning that they're not packing that much more risk in the 7-day options than the 14 options. So bank earnings are a big, like, you know, it's Captain Obvious stuff over here. All right, interest rates, how are they doing? Yada, yada, yada. Let's not worry about it. But you know what? When it really comes down to it, what's going to start to matter? People want to start to hear from big tech. And the big tech company that releases earnings, okay, before pretty much anybody else in terms of tech would be Netflix. And Netflix, when you start talking about like Netflix, here's where things get maybe a little bit crazier. We're talking about that volatility differential. Yeah, look at this. This volatility, okay, differential, it's getting there. Okay, so that's 62 versus 50. Things are going to get real nutty too by like Monday, okay, or Tuesday, because Netflix earnings, I believe they come out next Wednesday. The reason I want to look at Netflix, and I just want to talk about it, albeit briefly, okay? Netflix doesn't matter just so much for Netflix. By the way, Netflix, I worked at the brokerage, you know, in the brokerage world 15 years. And obviously Netflix wasn't public the entire time. But when people really latched on and started trading Netflix, and I remember times like, you know, 2010, 2011 specifically, Netflix is the widow maker of traders, especially those that sell options naked. Netflix has had multiple five Sigma moves after earnings announcements. So never forget that. Widowmaker and Netflix, right? That's just trading, not because of some of their shows. Anyway, when you start to look at Netflix, it's subscribers, okay? Subscribers, though, I think are going to talk a lot about the global growth concerns, okay? Global growth concerns. So when you start to look at global growth, everybody right now is questioning what's Europe doing, what's you know, China doing. Push China aside for right now because Netflix is obviously, it's not going to impede upon China. But when you talk about European growth concerns, right? I think that Netflix, okay, is going to hold keys to that. I want to see what their subscriber, like their numbers look like. You wouldn't think this, but you know, it's a $15 a month charge when markets start to turn south. And I'm not talking about stock markets. I'm actually talking about the economy, okay? When, okay, like Main Street really starts to turn south, subscriber growth will halt. People even start to cancel stuff. $15 makes it different when you know, the big difference when you're living kind of like, you know, hand to mouth and day to day out there. Netflix is going to be a tell-all, okay, in terms of subscriber growth or lack thereof. Listen, it's a lot to think about on this weekend's video. I hope it gave you, you know, a pretty decent idea of what you're looking at. Well, on a lot of different fronts over here. Everything from, again, bond shocks to gamma squeezes, okay, looking at VIX volatility spreads, Amazon next to the all-time high, and most importantly, some of the big earnings that are coming out. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.